All right, let's talk about an investment world that's been hiding in plain sight for decades. It's been one of the most powerful ways to build wealth on the planet, but for most people, it's been completely off limits. We're going to look at the insane returns, the huge risks, and a wall that, believe it or not, is finally starting to come down. So let me just ask you this straight up. What if I told you that the single best performing investment of the last, say, 25 years was something you were legally forbidden from touching? It sounds kind of crazy, right? Almost like a conspiracy. But for a very, very long time, that's just how the financial world worked. Well, it was real. And that asset class is called venture capital, or VC. This is the world where investors get in on the ground floor of high-growth startups, hoping they found the next big thing. And for forever, unless you are already wealthy, what they call an accredited investor, that whole world was completely sealed off from you. Now, calling it the best investment, that's a pretty bold claim. So let's not just take my word for it. Let's actually prove it. We're going to dig into the hard numbers that back this whole thing up. Check this out, 32.4%. That was the average annual return for top-tier venture capital for a full 25 years, according to the benchmark data from Cambridge Associates. I mean, that's not just a good number, that is a staggering, world-beating number. And here's what that looks like in context. Over that exact same period, the NASDAQ did great, returning about 11.3% a year. The S&P 500, a solid 9.1%. But venture capital, it didn't just beat the public markets, it lapped them multiple times. It wasn't even close. So how in the world does this engine generate so much horsepower? What's the secret sauce? What's the model that allows for this kind of crazy outperformance? Let's pop the hood and see how it works. Well, first off, VC success doesn't come from playing it safe and diversifying everywhere. Not at all. It comes from extreme focus. A whopping 71% of all venture capital money goes into just two places: technology and healthcare. This isn't about hedging your bets. It's about making huge, concentrated bets on the sectors they believe can literally change the world. And the model is about so much more than just writing a check. VCs are active partners. They don't just hand over cash. They give these tiny early-stage companies crucial capital plus expertise. They're on the board, they're making calls, helping to steer this little startup from just an idea into a successful company. That hands-on approach is key to unlocking those massive returns. Okay, before we all get too excited and start looking for startups to invest in, we need a major reality check. Because those incredible average returns we just saw, they are not spread out evenly, not even a little bit. The world of VC runs on a brutal, almost unforgiving mathematical rule. And here it is. You might have heard of it as the Pareto principle or the 80-20 rule. In venture capital, it's called the power law. It basically means that a tiny, tiny fraction of investments generate almost all the profits. Think about it. In a portfolio of 10 companies, maybe 1 or 2 become massive home runs that pay for everything else, while the other 8 or 9 completely fail or just break even. All the money is made on a few spectacular winners. And that same power law applies to the VC funds themselves. The difference between the best and the worst funds is, well, it's a giant chasm. The top quartile funds, the best of the best, they're the ones putting up those amazing 15 to 27% returns. But the funds in the bottom quartile, they're barely making any money at all, like low single-digit returns. So all of a sudden, who you invest with, the manager you pick, becomes maybe the single most important decision you can make. Okay, quick sidebar to break down some lingo you're gonna hear all the time: vintage year. It sounds fancy, but it's super simple. Just like with a bottle of wine, the vintage year is just the year a fund starts making its investments. And it's really important because it lets us do an apples-to-apples comparison of funds that were all started under the same economic conditions. And that wine analogy really holds up. Some vintages are absolutely legendary. And here's the crazy part. Some of the best times to start a VC fund are right after a market crash. It sounds backward, right? But with less competition and cheaper company valuations, funds that started in, say, 2009 went on to produce some of the best returns in history. Okay, so let's recap. We've got the best performing asset class, but it's super risky. And for decades, it's been incredibly exclusive. But the story doesn't end there. In fact, the whole game is changing as we speak. For the very first time, that massive wall that has always separated everyday investors from this elite world, it's starting to crumble. Technology and new regulations are fundamentally rewriting the rules that kept this world private for so long. And the key to all this change can be summed up in 2 words: investment crowdfunding. Thanks to some new laws, platforms like Microventures, AngelList, and Seed Invest now let non-accredited investors, and hey, that's most of us, invest directly into startups. And sometimes you can get started with as little as $100. This isn't just a small shift, it's a revolution in investing. Now, if you're thinking this sounds interesting, the way forward has to be with caution. You've got to start by researching all the different platforms to see which one makes sense for you. But you absolutely have to understand the high-risk game we've been talking about. You should only start with small amounts of money you are totally prepared to lose. And to fight that power law risk, you want to try and diversify across a bunch of different startups, not just 1 or 2. So, let's wrap this up. What's the big picture here? What's the main takeaway from this dive into the world of venture capital? Well, it's a classic story, really. It's a powerful new opportunity that is tied directly to some pretty significant risk. So let's just put it all together. For a generation, the best performing asset class was completely off limits to you and me. Its incredible returns were driven by a few massive home runs because of something called the power law. But now, for the first time ever, crowdfunding is prying that door open for everyone. You just have to remember that core rule of investing. This new, high-reward opportunity will always be paired with high risk. And that's where we'll leave you. For decades, the doors to the world's highest returning investment were locked tight. Now, they're finally creaking open. And this is honestly one of the biggest changes to the investing landscape we've ever seen. The question is no longer if you can get in. The question is, are you ready to walk through? Thanks for joining us.